welcome to Tecnia TV. I, Sheetal Badesra, Faculty of Management Department from Tecnia Institute of Advanced Studies. Today, I will be delivering a lecture on venture capital. What is a venture capital? It is a private or institutional investment made into early stage or startup companies. As defined, ventures involve risk, having uncertain outcome in the expectation of a sizable gain. Venture capital is money invested in businesses that are small or exist only as an initiative, but have huge potential to grow. The people who invest this money are called venture capitalists. The venture capital investment is made when a venture capitalist buys shares of such a company and becomes a financial partner in the business. Venture capital investment is also referred to the risk capital or patient risk capital. It includes the risk of losing the money if the venture does not succeed and takes medium to long term period for the investment to fructify. Venture capital typically comes from the institutional investors and high net worth individuals and is pooled together by dedicated investment firms. It is the money provided by an outside investor to finance a new, growing or troubled business. The venture capitalist provides the funding knowing that there is a significant risk associated with the company's future profits and cash flows. Capital is invested in exchange for an equity stake in the business rather than gives as a loan. Now, we will be discussing features of venture capital investment. Number 1, high risk. Number 2, lack of liquidity. Number 3, long term horizon. Number 4, equity participation and capital gains. Next, venture capital. Investments are made in innovative projects. Suppliers of venture capital participate in the management of the company. Now, let us discuss about the funding process. Approaching a venture capital for funding as a company. The venture capital funding process typically involves 4 phases in company's development. Number 1, idea generation. Number 2, startup. Number 3, ramp up. And last, exit. Step 1, idea generation and submission of business plan. The initial step in approaching a venture capital is to submit a business plan. The plan should include the below points. There should be an executive summary of the business proposal, description of the opportunity and the market potential and size, review on existing and expected competitive scenario, detailed financial projections, details of management of the company. There is detailed analysis done on the submitted plan by the venture capital to decide whether to take up the project or no. Step 2, introductory meeting. Once the preliminary study is done by the VC, that is venture capitalist, and they find the project as per their preferences, there is a one-to-one meeting that is called for discussing the project in the detail. After meeting, VC finally decides whether or not to move forward to the due diligence stage of the process. Step 3, due diligence. The due diligence phase varies depending upon the nature of the business proposal. This process involves solving of the queries related to the customer's references, product and business strategy, evaluations, management interviews and other such exchanges of information during this time period. Step 4, term sheets and funding. If the due diligence phase is satisfactory, the VC offers a term sheet, which is a non-binding document explaining the basic terms and conditions of the investment agreement. The term sheet is generally negotiable and must be agreed upon by all parties, after which on completion of legal documents and legal due diligence, funds are made available. So, I hope that you have understood the topic venture capitalist. Thank you very much.